Have you ever wondered how a company can spend a huge amount of money on something today, yet claim the tax benefit little by little over many years? If you've ever bought software, a patent, a trademark, or even a business, you've already encountered a concept called amortization, and understanding it can help you better understand profits, taxes, and how smart businesses manage their finances. The answer is usually no. Instead, businesses often spread that cost over several years. This process is called amortization. In simple terms, amortization means gradually spreading the cost of an intangible asset over its useful life. Now, don't worry about the term intangible asset. An intangible asset is simply something valuable that you can't physically touch. Examples include software licenses, patents, trademarks, copyrights, customer lists, and goodwill acquired during a business purchase. Think of it this way. Imagine you buy a gym membership for 1 year. You pay the entire amount up front, but the benefit is not used in a single day. You enjoy the membership throughout the year. Businesses apply the same logic to many intangible assets. Instead of recognizing the entire cost immediately, they spread the expense across the years during which the asset provides value. That's amortization. The formal accounting definition is simple. Amortization is the systematic allocation of the cost of an intangible asset over its useful life. Now let's see why this matters. Without amortization, a company might show a huge expense in 1 year and almost no expense in future years. That would make profits jump up and down dramatically. Amortization helps match expenses with the periods that benefit from the asset. This creates more accurate financial statements. But here's where things become really interesting. Amortization can also create tax benefits. When a company records amortization expense, that expense is often deductible for tax purposes. And deductible expenses reduce taxable income. Lower taxable income usually means lower taxes. Let's look at a simple example. Suppose a company buys a patent for $100,000. The patent is expected to provide value for 10 years. Instead of recording a $100,000 expense immediately, the company amortizes it over 10 years. The annual amortization expense becomes $10,000 per year. Now imagine the company earns $200,000 before amortization. Without amortization, taxable income would be $200,000. With amortization, taxable income becomes $190,000 because the company can deduct the $10,000 amortization expense. If the tax rate is 30%, that deduction could save approximately $3,000 in taxes for that year. One common misunderstanding is confusing amortization with depreciation. They are very similar, but they're used for different types of assets. Depreciation applies to tangible assets, things you can physically touch, like machinery, vehicles, or buildings. Amortization applies to intangible assets, things like patents, software, and trademarks. Another common mistake is thinking amortization means cash is leaving the business every year. That's not true. The cash was usually spent when the asset was purchased. Amortization is an accounting expense, not a recurring cash payment. So, what is the practical takeaway? If you're an entrepreneur, understanding amortization helps you estimate future profits and tax obligations. If you're an investor, it helps you analyze company earnings more accurately. If you're a manager, it helps you understand how major investments affect financial statements over time. And if you're simply learning finance, amortization is one of the key concepts that connects accounting, taxation, and business decision-making. At its core, amortization is about fairness and accuracy. A business receives benefits from an intangible asset over many years, so the cost is spread across those same years. This creates more realistic profits, more meaningful financial reports, and often valuable tax deductions along the way. That's why amortization isn't just an accounting term. It's a powerful tool that helps businesses manage costs, report earnings accurately, and optimize taxes. If you found this explanation helpful, don't forget to like the video, subscribe to the channel, and check out our other simple finance and business explainers. The more you understand these concepts, the smarter your financial decisions become. See you in the next video.